Hello, everyone, and welcome back to What Changes. I am your host, May. If you have been watching the markets over the last 24 hours, you probably feel like the ground is shifting beneath your feet. We are seeing moves that defy standard logic, volatility that is shaking out even the most experienced traders, and a level of chaos that requires us to stop, take a breath, and look at the data. We need to talk about silver. We need to talk about what just happened. Because it wasn't just a dip, it wasn't just a correction, it was a crash. And more importantly, we need to talk about why it happened, because the mainstream headlines are missing the mechanical reality of what is driving this price action. But before we dive into the charts and the data, I want to offer a resource. In times of extreme volatility like this, the difference between panic and profit often comes down to your foundational knowledge. If you want to deepen your understanding of how markets really work, beyond just the daily noise, I have a recommendation for you. Check out the description below for a book I suggest on stock market investing. It is a great resource if you want to build a foundation that can withstand this kind of storm. Now let's get into the reality of the market. Silver has crashed another 16%. Let me repeat that so it sinks in. 16% in a single session. This happened right on the heels of a two-day rebound that gave so many investors hope that the worst was over. It looked like we were stabilizing. It looked like the bottom was in, but it wasn't. That recovery was erased in the blink of an eye. Spot silver plummeted to $7.79, completely wiping out the gains from earlier in the week. And it is not just silver standing alone in this storm. Gold is down 1.7%. Platinum is sliding nearly 8%. Palladium is falling by over 5%. And while all of these precious metals are selling off, the US dollar just surged to a near two-week high. Everything is moving at once, and everything is connected. This is not a series of isolated events. It is a chain reaction. In this episode, I am going to break down exactly what happened, drawing on critical data from major financial institutions like Goldman Sachs. We are going to look at why this selling is happening, why it is different from a fundamental collapse, and what you need to watch over the next 48 critical hours. To understand why silver dropped 16% in a single session, we have to look beyond just selling. We have to look at the mechanics of the market itself. This isn't just about people deciding they don't want silver anymore. It is about a structural breakdown in how price is discovered. Christopher Wong, a strategist at OCBC, described the current environment perfectly. He said that sentiment has turned soggy across most asset classes, including precious metals, cryptocurrencies, and regional equities. But here is the key part. He noted that losses are feeding into one another and creating a self-reinforcing feedback loop amid thin market liquidity. That phrase, self-reinforcing feedback loop, is the most important concept you need to understand today. This is exactly what we are seeing play out on the charts. Let me explain how this loop works, step by step, because it is the engine driving this volatility. First, the price drops. Maybe it is just a small drop initially, but that drop triggers stop losses. These are automatic sell orders that traders place to protect themselves. When those stop losses hit, they trigger more selling. That additional selling pushes the price down further. Now, here is where it gets interesting. As the selling intensifies, dealers, the big institutions that facilitate trading, have to adjust their own books. This is where dealer hedging comes into play. According to a note released by Goldman Sachs on Wednesday, as prices fell, dealer hedging flipped. Normally, dealers might buy into strength to facilitate the market, but in this scenario, they flipped to selling into weakness. Think about what that means. The people who facilitate the market are adding to the selling pressure exactly when the market is already falling. This creates a cascade. Investor stop-outs are triggered, losses cascade through the system, and the price falls off a cliff. This is not fundamental selling. This is not a miner deciding to sell their inventory because they think the price is too high. This is mechanical. It is technical. It is forced liquidation. Goldman Sachs pointed out something else that is incredibly important. They noted that silver's correction has been larger than gold's. Why? Because of tighter liquidity conditions in the London market. The London market is where a huge amount of physical silver trading happens. When liquidity is thin, meaning there aren't enough buyers to absorb the sellers, price swings get magnified. You get moves that make no sense from a fundamental perspective, but make perfect sense from a mechanical perspective. A drop that might have been 10% in a normal market becomes a 30% crash, or a 16% crash, because everyone is trying to exit through a tiny door at the same time. One of the most fascinating aspects of this crash is the geography of the selling. Where is this pressure coming from? Is it global? Is everyone dumping silver? The data suggests the answer is no. Goldman Sachs noted that the timing of the volatility suggests that Western flows, rather than Chinese speculation, are behind much of this build-up and unwind. Here is the smoking gun. Most of the more violent moves occurred while Chinese futures markets were closed. Let that sink in. The crash happened while the biggest consumer market in the East was asleep. This tells us that the selling pressure is primarily coming from the West. It is coming from leveraged positions in New York and London. These are positions that are being forced out by margin calls and stop losses. This is a critical distinction. This is not China dumping metal. This is not a collapse in fundamental demand from the East. This is a Western liquidation event. It is a financial market event, not necessarily a physical market event regarding the end user. However, we cannot ignore the other side of the coin. While the selling is mechanical, there are fundamental headwinds that triggered this sentiment shift. We have to look at the bearish case honestly, because if you only listen to the bullish case, you are going to get hurt. Let's look at why the bears are winning right now. The industrial demand story, the core thesis for silver, is facing some challenges at these price levels. Kunal Shah, the head of research at Nirmal Bank Commodities in Mumbai, made a very significant statement. He said that industrial demand has vanished at the higher levels. He noted that most industrial buyers have stopped buying silver, and even solar panel producers in China are looking for alternatives. This is a big deal. Silver's long-term thesis is heavily tied to solar power and industrial use. If prices get too high, industrial buyers don't just keep buying blindly, they pause. They look for substitutes. They wait. If industrial buyers go on strike, that removes a key pillar of support for the price. Shaw also said something that every silver investor needs to hear. He said, if you remove geopolitical tensions and the de-dollarization trend for the time being, the metals have little room to run. Essentially, if the fear trade evaporates and the dollar stays strong, who is left to buy? And speaking of the dollar, that is the second major headwind. The dollar has received a new lease of life. The nomination of Worsh has been viewed as a positive for the currency. The dollar has risen to a near 2-week high. This is basic economics, but it matters enormously. Most commodities, including silver, are priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy an ounce of silver. Conversely, it makes silver more expensive for international buyers holding other currencies. A strong dollar is like gravity for precious metals. It pulls them down. KCM chief trade analyst Tim Waterer noted that traders are now more circumspect on gold and silver in light of this volatility and the dollar's strength. There is a third factor driving this crash, and it is perhaps the most painful for retail traders: leverage. The exchanges are fighting back against speculation. According to Sunil Garg, managing director of Lighthouse Canton, the CME, the Chicago Mercantile Exchange, has raised margin requirements multiple times. Margin is essentially a down payment on a trade. When you trade futures, you put down a small amount of cash to control a large amount of silver. When the exchange raises margin requirements, they are telling you that you need to put up more cash to hold that same position. This makes it dramatically more expensive to hold leveraged positions. It is specifically designed to flush out leveraged players. If you are a speculator using borrowed money and the margin requirement goes up, you might not have the cash to cover it. So what do? You are forced to sell. You are squeezed out. Garg believes that speculator positions have not been fully flushed out yet. His advice? Wait a bit more. Let the speculative positions get wiped out first before considering an entry. This brings us to a comparison that has been floating around the financial world, and it might sting a little. Market watchers have started comparing the silver trade to GameStop. Steve Sosnick, the chief strategist at Interactive Brokers, said that the precious metals theme captured the public attention and led to momentum trading that exceeded even the type of outsized moves we have seen in a wide range of speculative assets. When professional analysts are comparing silver to a meme stock that should give us pause, GameStop went from $300 down to $40. Meme trades do not end well for the people who buy at the top. The momentum attracts people looking for a quick win, but when the music stops, the exit door is too small. This comparison is unfair in some ways, but accurate in others. It is unfair because silver has genuine industrial demand and genuine supply constraints that a video game retailer never had. Silver is a critical industrial metal, but the comparison is accurate because the short-term trading dynamics have become unhinged from fundamentals. When you see a 146% gain followed by a 30% crash, that is not normal price discovery. That is speculative excess being built and then violently unwound. Now, I want to pivot. We have looked at the bearish case. We have looked at the mechanics of the crash. But is the silver story actually over? Is the bull market dead? Let's look at the data, because the bears are not telling the whole story either. First, let's look at performance. According to LSEG data, silver gained 146% in 2024 before this correction, 146%. Even after a 30% crash and a 16% crash, silver is still massively up on the year. Corrections of this magnitude are painful. They are terrifying, but they are not unusual in major bull markets. Every significant move higher in history has had violent pullbacks along the way. The question is not whether the price is down today. The question is whether the structural bull case is intact or broken. Sunil Garg, the same analyst who warned about leverage, notes that while he is bearish short-term, the thesis is not broken. Silver has a wide range of industrial and technological uses, extending from solar power to catalysts to electronics. The solar demand story is not dead. Yes, China may be looking for alternatives at these high prices, but looking is not finding. And even if they reduce the amount of silver used per panel, the total number of panels being installed globally is growing exponentially. The sheer volume of solar expansion creates a floor of demand that isn't going away. Second, let's look at geopolitics. Yes, there are headlines about tensions easing. Iran and the US have agreed to hold talks in Oman. China is considering buying more US farm soybeans. President Trump called talks with Xi Jinping very positive, but let's be real. Easing is not the same as resolved. These are talks. These are negotiations. Nothing is signed. Nothing is final. Any breakdown in these talks, any negative headline, could instantly reverse the safe haven selling we are seeing right now. The world is still a volatile place. There is another nuance to the bullish case that the market might be missing, and it involves the dollar. The dollar rallied on the Worsh nomination, but analysts have noted that Worsh's actual policy stance is much more nuanced than the market's knee-jerk reaction suggests. Worsh is bullish on AI and productivity. He believes that AI-driven productivity gains allow the economy to grow rapidly without triggering inflation. Why does this matter? Because if inflation is kept in check by productivity, it gives the Federal Reserve cover to support rate cuts. Even if the economy is strong, rate cuts are traditionally bad for the dollar and good for precious metals. If Worsh actually implements the policy he has discussed, the current dollar rally could reverse. If the dollar weakens, the headwind against silver disappears, and we could see a massive resurgence in price. And finally, we have to go back to that Goldman Sachs note. Remember what they said about the selling? They confirmed it is mechanical forced liquidation. It is dealer hedging flipping. It is stop-outs cascading. That language describes a technical unwind, not a fundamental change in value. This is crucial. When technical selling exhausts itself, when the last leveraged trader has been forced out, the fundamentals reassert themselves. If you believe the fundamentals are intact, then this is an opportunity. If you believe the fundamentals are broken, then this is the start of a bear market. So, where do we go from here? The next 48 hours are absolutely critical for determining the direction of this market. We are at a crossroads. Here is your watch list. This is what you need to be monitoring to see if we are stabilizing or if we are heading lower. Number 1, watch the Asian markets. Shanghai, Hong Kong, Tokyo. They open first. They will set the tone. Specifically, watch Shanghai silver prices. If you see Shanghai silver stabilize or rise while Western markets are closed, that tells you physical Asian demand is absorbing the Western liquidation. That is a very bullish signal. However, if Shanghai gaps down hard, following the Western lead, that tells you the selling pressure has gone global. If the East stops buying, the floor falls out. That would be bearish. Number 2, watch the dollar index. If the dollar continues pushing to new highs, it puts continued pressure on all commodities. It acts as a lid on silver prices. If the dollar stalls or reverses, that lid is removed. Number 3, watch for news on the Iran talks. The meetings in Oman on Friday could produce headlines that move markets in either direction. A breakthrough would reduce the geopolitical premium and could send metals lower. A breakdown or an escalation would do the opposite. Number 4, watch Bitcoin. I know, this channel focuses on precious metals, but Bitcoin has become a sentiment indicator for risk assets broadly. It is showing weakness right now. If Bitcoin breaks down further, it suggests risk-off sentiment is spreading. That means investors are fleeing anything speculative, and silver could get dragged down with it. If Bitcoin stabilizes and bounces, it suggests the forced liquidation phase is exhausting itself, and stabilization could follow across all asset classes. This brings us to the most important practical takeaway. How do you navigate this? If you are a long-term holder, a stacker, these moves are noise. You are not trading the daily chart. You are accumulating a real asset with a multi-decade thesis. Short-term volatility might change your entry timing, but it does not change your conviction. In fact, for the patient buyer, this is an opportunity. When forced sellers are dumping assets at any price because they have to, not because they want to, patient buyers can acquire those assets at prices that do not reflect fair value. But, and this is a big but, if you are leveraged, this environment is deadly. If you are trading with borrowed money, these moves can wipe you out regardless of whether you are ultimately right about the long-term direction. Being right about the destination does not matter if you blow up before you get there. The CME margin hikes are specifically designed to flush you out. If you are using leverage, you need to ask yourself honestly if you can survive another 10% drop, because more volatility is almost certainly coming. Let's bring this all together. Here are the 3 key takeaways you need to leave with today. Takeaway number 1. Today's 16% crash in silver was not fundamental selling. It was mechanically forced liquidation cascading through thin markets. The Goldman Sachs analysis confirms this. Dealer hedging flipped from buying strength to selling weakness. The timing, occurring while Chinese markets were closed, confirms this was primarily a Western speculative unwind. The fundamental case remains, but the speculative excess is being washed out. Takeaway number 2. The dollar surge is real, and it matters. The Worsh nomination has given the currency new life, making silver more expensive for the rest of the world. However, keep an eye on the nuance of his policy regarding productivity and rate cuts. If the dollar strength persists, it is a headwind. If it reverses, the path clears for silver. Takeaway number 3. The next 48 hours will decide the trend. The Asian market reaction, the Iran-US talks, and the US-China trade developments are all converging. We will either see stabilization and a recovery, or we will see continued liquidation. Markets are not rational in the short term. They are driven by fear, greed, leverage, and forced liquidation. What we have seen over the past week is an extreme example of this, but eventually, prices stabilize at a level that reflects genuine supply and demand. I believe the long-term thesis for precious metals remains intact. The supply and demand dynamics favor higher prices over time, but in the short term, anything can happen. If you are positioned appropriately for your risk tolerance, you can weather this storm. If you are overextended, this environment will punish you. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Thank you for tuning in to What Changes. I hope this deep dive helped clarify the chaos we are seeing on the screens. Don't forget to check the description for that book recommendation on stock market investing. It's a great tool for times like these. Stay sharp, stay informed, and make decisions based on logic, not emotion. I'll see you in the next one.